This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and make profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 197. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rcraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Quick announcement, we're about a month and a half away from the SNN Network Canada virtual event happening December 7th through 9, 2021. Paul Andriola from Small Cap Discoveries and myself on behalf of SNN Network are teaming up to highlight our neighbors to the north, Canada. In the last 5 to 10 years, small, micro, and nano cap investors have been finding value accretive opportunities in this space. So we decided to host an event that encapsulates all of this, especially some of these companies that are listed on the TSX, TSXV, CSE, and even the NEO. So you can expect 3 days of keynotes, educational panels, company presentations, and one-on-one meetings. To register, please go to canada.snn.network and click the register button. We look forward to seeing you all there. Now, for this episode of the Planet MicroCap podcast, I spoke with Edward Chang. He is the founder of Pledge Capital, and we recently met via Twitter after seeing that he shared a recent episode of Compounders. After doing some research on Edward and his firm, Pledge Capital, I can't believe it's taken me this long to find and have him on the show. As the title alludes, our conversation is all about hunting for compounders or companies undergoing transformations that could lead to a compounding scenario, the latter point being explored the most. I really enjoyed learning about Edward's approach, and he shares a few case studies that support his thesis. Thank you again for tuning into episode 197 of the Planet MicroCap podcast, and please enjoy my conversation with Edward Chang. Welcome back, everybody, to the Planet MicroCap podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And my guest today is a gentleman who we met, I'd say, relatively recently, vis-a-vis Ben Claremont through his podcast. And I stalked him. It was kind of one of those things. Just saw that he was interested in one of the interviews that we did. And I hit him up and said, I think we have a lot to talk about. So joining me right now is Ed Chang. He is the founder of Pledge Capital. Ed, thanks for joining me, man. How you doing?
Yeah, no, thanks so much for having me. I've watched a bunch of your videos in the past, so I guess I've stalked you as well. So it's all good. I've been a fan of your work, and thank you so much for having me.
It's great to have you. It's a mutual stalking relationship. I mean,
exactly.
The beauty of the internet, we can stalk each other and have no idea until one of us says, okay, exactly. I guess we should contact each other, right?
Yeah. It's been a fan of some of your work. We were talking earlier, must have watched your Joint, Avid, a bunch of other Village Farms videos in the past. So.
Oh yeah, no, and we'll definitely get into some of those case studies as well, because I think one of the coolest things that on your website you have a tagline, for your firm about keep compounding. And so with the podcast that we just started with Ben Claremont, Compounders podcast, the Anatomy of a Multi-Bagger, I think it'd be pretty cool to hear your definition on compounding. But we'll get there. There. Everybody listen. We'll get there. We're gonna build up to that. Because this is my first time. This is our first time chatting together. I'd love to start off with where your passion for investing began.
Yeah, no, for sure. I really have to give a shout out to my parents who helped me discover investing. My father bought a book by Matt Sato out in San Francisco, Wall Street Whiz or Whiz Kid on Wall Street. Forgot the exact name now, but I always loved history. I've always, I was a big gamer when I was younger, and when I picked up that book, just fell in love just with the stories Matt Stato shared on investing, and it just seemed like this tremendously interesting puzzle. And from there, just got introduced to the stock market, started to pick my own stocks, and never really looked back. It was really a passion first, and read everything I could absorb on it. And gosh, 20 years later, followed my dream, started Pledge Capital, and it's been a cool run.
So tell me, I mean, what age was that when you first picked up that book? Were you a teenager or high school?
Yeah,
Like, what was...
exactly. I was a teenager, probably 12 or 13, finishing up middle school. It was right after the tech bubble. So, it was a very fortuitous time to get started in the stock market. Lots of bargains. The first stock I picked, direct consumer, computer gaming company, ordered a laptop, ordered a computer, could customize, pick what video card I wanted. I thought it was a bargain versus what I could get at Best Buy or Circuit City back then. And long story short, everything was bombed out after the tech bubble. So it did well the first 2 years or so that it held it.
Very cool. All right. So, from the initial, passion for investing, catching us up to Pledge Capital, I mean, you must have had a couple jobs along the way that got you there. So
Yeah.
love to hear that experience.
Well, I eventually ended up at NYU studying business. And this was, I kind of went through that during the recession, right? A lot of those years were the recession years, and it was tough, right? I mean, but you have to play the long game. My first job out of school wasn't actually in investing. I ended up at Deloitte. But down my way, back to the sell side, I had interviewed on the buy side before. Actually, met the chairman of Anheuser-Busch and I believe Burger King too during that interview during my last round. But it didn't work out. But found myself back in the industry, covering restaurant stocks at UBS, where I learned a tremendous amount under Keith, my boss. He was a good stock picker, really good stock picker. I learned a ton about catalysts and business transformations, watched some super interesting strategic moves at McDonald's and Panera and Buffalo Wild Wings. And yeah, I interviewed and a bunch of folks on the buy side. Some opportunities there. They just wanted me to cover restaurants and REITs, right, and maybe one other sector. And the problem that I had with the sell side was just I felt really constrained, kind of handcuffed. I couldn't look at everything, right, and so that was a huge, one of the big factors in me, plus the fact that I've always wanted to do it, right? I've always wanted to start my own company. Part of it was also I had a lot of confidence in a new investment strategy that I was it was evolving in my head. It started with Netflix, right? Like it's this whole idea you want to buy like these transformations, companies that are about to go up an S curve. And I feel like I kind of finished that. I started that with Netflix, in 2013, 2014. Started to learn and develop that idea, and watching Panera and McDonald's and Buffalo Wild Wings go through similar transformations from whether it was digital transformation or refranchising strategy. Had a lot of confidence and wanted to go out there and see what kind of great investments that I could discover with this kind of idea, this philosophy in mind. And so that's when I made the leap and started Pledge Capital.
All right, there we go. So that's a perfect segue because, again, before we get into some of the case studies and compounding, I'd love to learn a little bit more, about your investment approach that you're looking to employ or that you've been employing at Pledge Capital, which you founded in 2016, correct?
That's right. 5 years now, a little bit over 5 years.
Nice. So let's hear. So let's hear that. Tell us a little bit more about the firm's investment approach.
Yeah, sure. So love compounders, right? I mean, you mentioned compounder and compounding, and that's what we try to do, right? Probably half the investments we try to target could be a young company, could be some sort of business that we think has a lot of compounding potential. Another bucket that we like to look out for are companies making some sort of transformation, right? That can become a compounder. Maybe it's not now, and it has the potential to become a compounder because of the strategic decisions that management is undertaking to transform the business, right? So, I think I got started in part due to Chuck Yeager. Back in 2010, 2011, I bought MasterCard and Google. And that's, where I feel like I really started on this journey looking for compounders. Businesses, by my definition, it's a business that has a lot of growth opportunity. It has, because there's a large TAM. There's a couple, one or a few strong competitive advantages that give me the confidence that they can actually execute and grow into this TAM. Lots of people have done a lot of work in this area, so I think at this point it's very well discussed. So definitely those two factors, and just good business, right? Like both Google and MasterCard are high margin, capital light businesses, and so learned a tremendous amount, about that model as well at UBS, analyzing franchise stocks. So I'm always keeping an eye out on these young companies that I think fit that criteria. Lots of room to grow, some reason that I believe they can win, and just a good model, and ideally run by a good management team. And sometimes I like to judge a management team on what they're doing, right? What kind of transformations they're undergoing to improve the business, right? Because companies have to evolve, right? The world is always changing, and good management teams will stay abreast or stay ahead of the curve. And so love it when I see a company's CEO and C-suite making changes that I think improve the competitive advantage of a company. That's the overarching kind of thought process.
Very cool. I actually wanted to dig a little deeper because you mentioned in your investment pitch deck about how on your investing philosophy side that you believe that market misprices companies that are on the cusp of inflection points that will enhance their value. So this is really an interesting rabbit hole for me because this is way more of an art than a science. Is trying to understand when some of these mispriced companies are on the cusp of an inflection point. What are some of the things that you look for when you are trying to find companies that fit that criteria? Like, oh, here we go. This setup is perfect.
No, that's a good question. And, a lot of times people naturally doubt what they don't understand, right? I think that's just a pretty human, characteristic. It's pretty human, kind of, I think something we all do. If we don't know it, lots of times we don't think very highly of it, right? And so there's that one factor. Coming from the sell side, talking to all these different investors, right? Like I really felt I got a sense of what like 100 investors thought on McDonald's or Panera during their transformations, right? And frankly, I think Wall Street often has a very short-term focus. They're really looking at the next quarter or the next 2 quarters. Like they're always asking, well, why hasn't it worked yet, right? Like it's taking longer. Is it actually working? Or things like, oh, it's taking them so long. Like, why can't someone else just do it too, right? Like there's going to be, people, they ask a lot of different questions, and they don't always believe these inflection points are actually going to work, right? And so what I like to look out for is, I mean, some people have called it kind of like an inevitable future, right? Like something that's so superior, so much better than what exists today, right? It's there's less friction for the customer. It's an improved experience. It's more convenient. Maybe it's cheaper. It's a better value proposition, right? And you pick compounders that way. And to a large extent, you have to judge a business transformation the same way too, right? Like, is this future that management team is building towards? Is it just fundamentally better? And so that's the main thing that I look out for, and I'm willing to overlook, because things don't get, Rome wasn't built in a day, right? Things don't take, they don't, they're that immediacy, that short-term focus. I think it's something that can be used, to your advantage, right? Long-term investor has an advantage over lots of other investors who are just more short-term focused, and so. If something's taking longer, I don't mind that, right? It's for me, it's all about looking out 2, 3 years. Is this fundamentally better than what's out there at the moment?
And that is so hard to do. Let's not devalue, or I don't, I'm missing the word, but like, let's not, underestimate like how difficult that actually is, because you could find a company where in that moment you might think, wow, like the value prop on this seems way better than it's either the legacy systems that are way things are done, or any of its competitions that trying to, make things more efficient. It's still really difficult. And then it's because a lot of it has to do with timing and making sure that not only do you find something that there is a real value prop there that is better than the competition and the legacy systems, but you're not late, right?
Yeah.
I mean, how hard has that been?
Yeah. So, yeah, that's why you really have to understand what the market, what the market thinks too. That's a really good point, right? Like, are you late, right? Or if you're late, can you scale that curve of understanding where you know the story well enough that you can still say confidently that it's still a good risk reward from here, and that it's judgment call at the end of the day, right? It's part art, it's part science. Even the smartest investors can get that wrong and sell out too early, right? I think the investment greats have always, like a Peter Lynch has always argued that the greatest error is selling out too early before before the story is really finished and fully appreciated, right? And the fact is, with some of these great businesses, they do have the potential to really outperform your expectations, right? Where you go back every quarter, year after year, and they're just beating what you thought was possible in your wildest kind of bullish scenario. And so there's definitely that aspect. And then there's also the aspect where this story now everyone understands, right? It's in 2, 3 years, pretty much the street understands the story, and so it's a balancing act between well, is there still a lot of room to grow, or is this so well understood and fully priced in? And so yeah, at the end of the day, that's not it's not easy to always get that right. And what we try to do is, we're always looking, we're always underwriting what the prospective IRRs are for 5, 6, 7 year period. And, when we look to swap one stock out for another one, one, our original investment, we probably know very well, and we have a lot of confidence in. So you have to, that becomes our cost of capital, right? That we compare everything against. And it's not easy, right? I think all investors have sold out of a stock earlier than they should have, or they left money on the table. But it's a balancing act, and it's a constant learning process.
Oh, absolutely. So as I alluded to at the open of this, the Pledge Capital has that tagline, keep compounding. I mean, I don't know. Firstly, are we compounder bros? Is that what we have to do?
I think so. Yeah,
we are.
I think I fall under that category for the most part.
Well, at least you accept it, right? I mean, I love it.
Yeah.
So I have to ask then, what, just like how everybody has it's seemingly their own definition of value investing and growth, and that, and just their own definition of those different styles at this point, for you, what does compounding mean to you?
I mean, at the base, it's about building wealth, right? It's about, the struggle that I always had with, I think, traditional value investing. And I'm not saying that I'm not a value investor. All, investors they're looking for values. It's a different definition of it. And, looking out longer to find something that's underpriced, right? And so for me, it's really about finding something where I don't have to come back in 6 months or a year and, okay, this is probably it, right? This is the best. Most of the alpha's gone. Now you have a 10 stock portfolio, and you're always recycling and churning the positions. And frankly, it's more work, right? I mean, the reason that I first got into MasterCard and Visa is because, I thought I could probably hold them for a really long time. And for me, that's like, if the stock can double, and I still believe it can double, for me, that made a lot more sense than looking for this low P stock that traded at 6 or 7 or 8 times that I think can double, and then that's probably it, right? Like cyclical business that, so maybe not at a low P, maybe at a high P, and you sell it at low P. But for me, it's just, I always thought it made more sense to look longer term, right? Look beyond that typical holding period, right? Like that alpha, or I'm holding for a double, and then there's probably not much juice afterwards, right? Like I want to look for, oranges and when lemons that have a lot of juice, right? Like after you've juiced it replenishes itself. And so that was always the goal, right? That's the reason that I eventually over time switched from what, you think of as more typical value to compounding growth type investments. And that's not to say that value investing doesn't work. I think it does work, right? I think growth investing it's part of value investing. And I still find stocks to this day that, in my opinion, sell for a discount to the net asset value, right? Replacement value. But I'm only really interested in those stocks if, I can look out 5-10 years and get a ton of growth potential. Right? I can see or project out, a range of scenarios, including some, or, on average, scenarios that, there's probably 3, 4, 5x upside to, income. And that's only time that I feel I'm very interested in that, traditional value investing type approach, because you solve for the problem of that constant churn, right? Like I think when I was younger, a lot of the stocks that I gravitated towards didn't hold them for that long, right? I was trying to buy things that were going to mean revert. Wasn't necessarily thinking 3, 5 or more. But, given my experiences the last 10, 12 years, holding Google for example, for the better part of a decade, it just makes all the sense in the world to me to look for those investments. I think it's a better use of our time, and there's higher potential.
Well, let's get into some of those case studies.
Sure.
You talk about a few of them, and I think you've even pitched them on some other platforms as well. And this isn't a pitch session, everybody, but more of some to talk about some case studies that exemplify, what you do and what you really look for. And so, the first two that kind of stood out to me because I have interviewed them many times, Joint Corp. Not a shareholder. And also we just featured Avid Technology on Compounders, also not a shareholder. So what about those two in particular did you see at the time when you made your initial investment? And according to these, I think they were two of your highest returns on your original investment.
Yeah, some of I would say two of the highest since we started and launched Pledge Capital for sure. So what I saw with both of them, and I still think it's true, is that they have a relatively low market share, right, of their current opportunity. So there definitely is that potential, right? And it's like how you define it, right? With the joint, it's very obvious. They have a really low market share of the total chiropractic industry. And obviously the market has come to understand that opportunity, where they provide a ton of value, right? Quality adjustments at a value price. When I pitched it, it was, I was comparing it to insurance, right? Like if you had insurance, you saw a chiropractor, your copay was oftentimes more than the $20 that you spent to get a joint adjustment, right? And it's actually a pretty big time savings. It's more convenient. You're stopping by after you're going to the grocery store or to the gym. It's very conveniently located. You're not wasting a ton of time in there. The typical chiropractic adjustment can be quite like it could take 30 minutes, 40 minutes, right? And the joint prides itself in delivering service in 5, 10, 15 minutes, right? Like it's more convenient and it's just frankly a better value. So given that value prop, I thought there was a very, they were well positioned to take market share. They had figured out the unit economics of their their small box retail locations. I liked Peter Holt, and I thought he had a good track record running and building out mailboxes. The UPS stores. I liked the management team, right? I liked what they were doing with regional developers, bringing in these partners who had skin in the game to help recruit, train, and manage franchisees, right? These are very often successful franchisees in the system who have had other business successes. And so, in my opinion, they're very well qualified partners to help grow the system. They de-risk growth, right? I often compare it to the master franchise model used by some other franchise systems, franchise chains, to help them grow, and especially internationally. So it was something that I liked. I liked that move, despite investors criticizing they're giving up too much economics, right? Like I think it's more important to grow the total pie as opposed to fight for the pieces of it, right? It's much more important to enlarge it. And so that was a dynamic that I saw at the joint. A model that I was very familiar with, really good value prop, and there's a lot of similarities with Avid, right, as well. Depending on how you cut it, right, they have very high market share of the premium end, the Hollywood, right, the Hollywood and the really professional music and the audio side of the business, but they have really little, if very minimal market share of the entire professional content, you know, uh, the tool set for the entire content creation industry, right? They have for the average YouTube video, very few people are using Avid, right? If you look at whether it's GarageBand or iMovie or Premiere or the litany of creative tools that people use, Avid doesn't really play into that. And I liked the transformation they were making from perpetual to subscription, right? Instead of charging 500, 1,000, 1,500 a license, they were lowering the barriers to try or use their product, right? They were pricing it at $20 or $50 a month. And they were investing to simplify the product, improve the user interface, make it easier for users to discover the various tools. And so, right, just let me explain that a little bit more. Very complicated software, and so helping people figure out, okay, so there's the color grading and the audio and the normal video editing and breaking these up into different workstations. And so I liked that transformation. I liked that they were investing in the cloud, investing in edit on demand, and just frankly just improving their overall product. So I saw a similar dynamic. I thought they were well positioned, if they choose to do so, to go after more market share outside of their core business, right? To potentially go down market. My friend Luis Sanchez has done some good work on their corporate opportunity with the Vimeo kind of customer set, right? There's a big opportunity there with millions and millions of companies now investing to create videos to talk to various stakeholders, internal or external. There's tons of YouTubers who are making money now, vlogging or in all the different niches, right? Like there's millions of people making money, right? And with podcasting too, right? There's more and more people who are making money as podcasters. And in my opinion, that's only going to continue. And so having that brand being known as, and if they should advertise this more, right? They're the, premier tool for editing the most complicated video, the highest end movies, right? And it's used by all these different musicians, whether it's, Ariana Grande or Coldplay or whoever, to make their music. If they advertise their $20 or $50 tool per month tool, I think they're well positioned to go after a much bigger slice of the overall pie, and to grow outside their Hollywood mode. So that kind of sums up. I think there's similarities between those two businesses.
Gotcha. And I have to ask, why did you end up closing out both positions? Or are you still a shareholder in either?
So look, I'm still a shareholder in Avid. It's still one of our top 5 positions. The joint, frankly, is a lot more of a cost of capital at this point. It's gone up 10x since we bought it. I struggle to get to the level of IRRs that I typically search for. So when I find something that has a 25 or 30% IRR, I sell the joint to buy that new investment. Obviously I understand it, the joint very well, and so that creates a high hurdle for me to go into something else. But I'm still bullish the joint long term over 5-10 time horizon, but I don't think the returns are nearly as good as some of the other things that I see now.
Gotcha. And so of all the case studies that you listed in your pitch deck, what would you say is the closest to this kind of near-term inflection point type investing? Which one of those did you look at like, I think if this had, like, not necessarily a binary bet, but like you're thinking to yourself, okay, these couple things happen, like this could really result in a lot of realized value.
From here? Do you mean from here? Something that isn't well understood and
No,
still moving towards that? Or just like the clearest example of that inflection point that
dang, now you put me on the spot. I want to know both. I guess I want to know both. Right?
Yeah, I actually think so. For the first, for the joint and Avid, they both had, they have both had factors. I think they both fit under that inflection point, right? Like, not to beat a beat a dead horse, but with Avid, I really like their move into the regional developer strategy. I really thought that was going to accelerate growth and improve their chances to capture their TAM. And with Avid, I really like their transformation. But those are I guess playing out. I think Avid still has a ways to go. I think advertising and building out a pipeline to advertise more, to invest in more performance advertising. That's still low, in my opinion, low hanging fruit. I think it's very likely they invest more than the $2 or $3 million they disclosed in their regulatory filings. I mean, I don't see why in a few years they're not spending 10, 15 or more a year on performance advertising, looking for well qualified leads that are likely to convert into paying subscribers. For something that's a little fresher and that I think is kind of building towards, I really like what Angie is doing. I really like what Oysen Hanrahan is doing over at Angie. The lead gen business is, I think there's a ceiling to what you can do selling leads to service professionals, and building out a marketplace, right? An Uber for professional services. That's very interesting to me. I think that's absolutely the right move to make long term. And they had a very funny quote in their last letter about how like home renovation projects, which take more time and cost more, building out this business, this marketplace business, this Uber of home services is also taking more time and costing more. But I absolutely believe it's the right thing to do and to pursue. And I really like that they're buying general contractors, networks. I think there's a lot of opportunity for them to do that and invest in contractors who are a little bit more tech savvy, a little bit tech forward, that have come up with some interesting ways to deploy tech. And I look forward to seeing what they do over the next 2, 3, 5 years, because I think they're making the right moves, and I like what they're doing there. And that one's earlier.
Very cool. And last case study I have to ask you about is, your Netflix thesis and looking at that and how that went for you guys. So it from what I understand, you were a shareholder in Netflix before you started the fund, and then you redeployed capital once you did start the fund, and you made 1.5x gain on that investment. And tell us what your thesis was when you then redeployed the capital during that time.
We actually owned Netflix at the beginning, in 16. In 16, 17, I think for part of 18 too. Obviously ended up being, another of those mistakes where you sell too early. And with Netflix, I also didn't hold enough of it. Both the first time I bought it after the Quickster debacle, and also at the beginning of launch. And yeah, look, it's a very important mental model that we have, watching and learning from Netflix. The especially the first time around, but also the second time around when we bought it again. The first time management was building out DVD stream. Sorry, they were building out streaming, right? They had a cash cow in the DVD business. I remember binge watching and discovering binging in probably 2012 or 13. Binging a bunch of different episodes and just falling in love with that no commercial model and just thinking, wow, this is a fantastic value. This is way better than cable. Anything you can watch on cable. And bought it after Quickster, really thought that the math made sense to split up the two and start to charge for streaming on its own instead of packaging together. While the street was angry that they're basically ramping prices up on subscribers like 60-70%. And so that's when I bought the first time, but I struggled to make the math work, right? After the stock went up 150%. I thought there was a lot of valid criticism from the shorts. There's constantly spending more money, right? They're burning cash, they're borrowing money, the balance sheet looks really bad. The cash flow statement looks really bad. Frankly, I couldn't model a path towards, profits, right? And I think it's one of those cases where a good management team, right? And Reed Hastings at this point, I consider him one of the best CEOs ever, where a good management team can outperform your expectations. And looking at what they did, the second time I bought them was at a much higher price, right? I sold it probably in the high teens, and I was buying it back at 5 times the price years later. But I really liked what they were doing with originals. I really enjoyed them. Really liked House of Cards back then. I thought there was, I basically created this list of all their originals and had the critic reviews, the viewer reviews, and just kept tracking them. And at some point, I was like, wow, this is a good portfolio of originals that they're creating. And not only does that generate that water cooler conversation, right? People now want to subscribe to Netflix because this is the only place you can watch this show. But it enhances the stickiness, right? Like you still want to subscribe in year 2, 3, 4 of House of Cards or Orange is the New Black so that you can watch those shows. And so it's good for advertising, it's good for word of mouth, and it enhances retention. And all now it actually addresses that short thesis where before revenue grows this much, costs go this much, and it constantly goes up the same proportion. And now you can kind of start modeling out that revenue is going to accelerate, and you can actually see a path towards costs, leveling out, and you can make the math work at that point. So I bought it back at a much higher price. The valuation still looked expensive. I should have made it a much larger position. I should have held it longer the second time as well. But we're always learning, and I like to think that I cut down on that mistake with the joint. Held that was my largest position, and it went up 10x, and I held it for the vast majority, the bulk of that position for the entire ride. So
Nice.
Hopefully make fewer of those mistakes going forward.
100%. Well, that's a hard mistake to learn from, right? You make a good amount of money, you're seeing that return. That's a hard one.
Yeah. Exactly, right? Like as a value investor, right? When back in 2003 or 2004, when you made 100% or 200% on an investment idea, you thought that was pretty good. I thought that was pretty good already. And so to break that habit and buy something at 5x what you sold it at, it was pretty tough. It took a while to get over that, because I remember just watching Netflix go from 18 to 25 to 30 to 60 to 100 something and then come back down. And I was kicking myself the entire time, right? And because I love the product, right? I was a very loyal subscriber for a decade now, and and you don't like it when you love a product and the stock keeps going higher and you're not involved. So it was tough.
I'm pretty sure, one of my favorite Twitter accounts, Ian Castle, always tweets about stuff like that. Like,
Yeah.
why not buy something that you love as it continues to go higher, right? Because I mean, there's a lot of math that's involved too. Don't get me, of course,
Right.
But at the same time, like just theoretically, like.
Yeah, he's a great teacher. He makes a lot of really good points. Love following. One of the best, absolutely. So many words of wisdom from his account.
I asked him one time in our last interview, I was like, how do you come up with this stuff? And he's like, it comes to me. And then I tweeted. And I'm like, that's so sick.
He's one of those guys. He's one of those older guys. He probably it feels like he has like a book of like 1,000 different smart things that he's like accumulated.
Yeah, 100%. All right, dude. Well, I want to now get to my favorite question that I ask everybody that comes on here. What would you say is an investing experience that really changed your career or taught you the most thus far, both in your career and or personally?
So for sure, definitely Netflix is in there as one of my top learning experiences. I mentioned before UBS covering McDonald's and Panera. Now, just like I said before, seeing that short-termism on Wall Street, company that was doing absolutely the right thing under Ron Shaich, investing to fundamentally improve the customer experience with online ordering, digital ordering, kiosks. He was ahead of his time back then. I mean, all this stuff now makes so much sense. It's basically obvious to anyone who goes to any of these chains now. But, in 2014, 2015, there was a lot of doubt, right, on what kind of impact that was going to have. And obviously with my pivot, I think that was another really key learning experience. And I have to credit Chuck Aker, who, I thought I learned a ton from just video interviews he gave. Forgot where at this point, right? But talking about his three-legged stool. And, I felt he really convinced me. He played a pretty big role in why I invested in Google. I just thought it's a verb, right? It makes all the sense in the world. It's free. It's so much value, right? Like Microsoft Bing, they're giving away like money to try to get you to use it, but I'm not gonna accept $50 or $100. I'd rather use Google, right? And just realizing, wow, I mean, every additional click, every $5 or $10 or $20 they collect, it's pure profit, right? Like that and MasterCard were tremendous learning examples, tremendous learning experiences, I mean. And I would say even going back earlier, right? Books like Philip Fisher, I think, just looking back, so much wisdom in that book. So many good, case studies and lessons to learn. I think just when I look at my involvement as an investor, that scuttlebutt research that Philip Fisher laid out in his book, Common Stocks, Uncommon Profits, it's only gotten more important to me as like the most important tool, in my opinion, just that scuttlebutt. And so every case study in there, I feel is so important. I've reread that book a few times at this point, and I feel like every time, like the first time I read it, I don't think I really got it. The second and the third time I read it, I'm still learning. And I'm really noticing, oh yeah, that makes a lot of sense. I'm actually doing stuff like that now. And what sounded like really foreign to me the first time reading it, now it's like, oh yeah, I see exactly what he means. And so that's a book that I highly encourage people to learn more about, and read more about, because first with me, walking through that Netflix example, right, really seeing it, right, from the consumer standpoint, right, loving the product, and all the big key investments that I've made the last 5 years, just walking through and performing that scuttlebutt, learned a ton, right? I'm still learning. I'm a young guy. I'm only 32, so I like to think I'm still learning and developing. And yeah, it's been a cool journey, really cool journey so far, and I'm looking forward to the next decade, two decades compounding and learning more.
Very cool. All right. Well, to close this out here today, and you kind of already alluded to my next question a little bit, but I mean, what advice would you have for new investors that, want to become compounder bros?
Compounder bros. Oh yeah, that's I think it's really important just to get out and do your own work, right? Like to unplug from a computer screen. I think there's a lot of value in watching interviews with other investors and with CEOs, but to like really get out there and do a lot of your own, primary research, right? Not just to, read stuff on Twitter and, really cut your teeth practicing. Like, I think that's the most important thing. You just have to keep developing. You have to keep developing your own case studies, right? Like, look out for and try to develop, right? Make investments that you think could end up in a textbook in the future, right? Look for those transformations that you think people will study in retrospect. I think you learn a ton from those experiences. And that's really it. Like, and talk to other investors, right? Get their thoughts, right? You can, I don't think you should take things personally, right? When someone comes up with like a valid critique, listen, right? And really think about it. I don't typically like argue. I don't seek to do that when someone comes, like I like to think about it and kind of take my time to kind of process that information. I think it's very valuable to talk to other investors and hear their the negative, right, the feedback, right. If it's always good to have an investor play devil's advocate to your view, and so you don't never want to be argumentative against that, right? You just want to listen and process, right? I mean, sometimes you can go back and then tell them what you really think, but really take the time first to consider. Looking back at some of my experiences, kind of go back to one of your earlier questions. Short sellers are very talented people. I think they do a lot of work. You want to read, the great books in that field, and you want to listen to short sellers, right? Like, I think they do a lot of good scuttlebutt research, and you can learn a lot from them.
Very good. All right. Well, Ed, with that, where can our audience go and find more information to follow you and to learn more about Pledge Capital?
Yeah, everyone, I'm happy when people reach out. So you can, definitely feel free to reach out. I'm on Twitter, Edward W. Chang. And, I posted some material on Pledge Capital / documents. So you can check out what we have posted there. I'm not as active. I wish I should, when I find time, I'm going to be more active. So I'm happy to chit chat if anyone wants to reach out and talk ideas. Always enjoy that.
Very good. Well, Ed, thank you so much for joining me today, man. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
You too, Bob. It was fantastic coming on here. Thank you so much for having me. Enjoy everything you put out, and look forward to keep the conversation going.
Oh, for sure. You'll be on a roundtable soon enough.
Cool. All right. Sounds good.
All right,
Thank you so much.
All right. Talk to you later. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.